Hey guys, Akil Stokes here. Welcome back to another episode of the Trading Coach Podcast. Today, I want to talk to you about the 3-5-7 rule, explain to you what it is, obviously, but also tell you why I like some of it, but also disagree with, I don't want to say most of it, but some of it as well. Now, before we get too stuck in, this is going to be a video episode of the Trading Coach Podcast. So make sure you head over to a platform where you can watch the video version. I know Spotify does it. I'll upload this onto YouTube as well. We are going to share some charts and graphs and fun things like that. So you don't need to see it, as I'll try to do my best to explain it, but visually, you learn a little bit better, so if you can, I recommend checking it out that way. So the other day, Jason Greystone and myself did an online workshop, which was on crack. Not that I know what it feels like to be on crack, but typically when we do these online trading workshops, we do them over a 3-day period. We do them 3 hours a day, so it's a lot of time to really walk you through the information nice and slow and make sure you learn it. We decided to do something different this time, first time ever, where we sat you down for 3 straight hours, 1-day event, and just gave you everything. And one of the things that we talked about was risk management. Now, as you can imagine, when we're trying to do everything on crack, right, we don't have a lot of time to take questions like we usually do. We're kind of rushing through because each segment has to be about a half an hour long. And one of the questions that I saw pop through that I didn't get a chance to answer was, Akil, what do you think about the 3-5-7 rule of risk management? Now, you're asking yourself, Akil, what is the 3-5-7 rule of risk management? And Akil is going to explain to you what exactly that is. We're playing a little drinking game in the back. Every time I say Akil, you got to take a shot or something like that. So, the 3-5-7 there we go. The 3-5-7 rule of risk management is this, and this is one of those kind of like, I don't want to say old historical rules, but like not a hard set rule in trading and investing, but like a common guideline that's out there to keep people safe, maybe, and I'll explain that in a little bit. But the rule states this: the 3, a trader should never risk more than 3% on any given trade. The 5, a trader should never have an outstanding risk, so like all risk at once on the table, of more than 5% of their account. And the 7, this one gets a little bit weird. The 7, you'll hear it phrased differently, but essentially the 7 is you should have a 7-to-1 risk-reward ratio. And by risk-reward, I mean your wins should be 7 times your losses on your average trade. Now, before we hop too deep in, I'll share my brief opinion and I'll walk you through some of the benefits and some of the, the drawbacks of this rule. But the 3% risk per trade, I do like that rule. You guys know I risk up to 2% max. I think that, and not just me thinking, but if you ask many professional traders out there, 3 is typically the limit that we would recommend you risking per trade. So if you're very, very risky, you're risking 3% per trade. And what 3% means is 3% of your total account balance. Most traders you'll see will risk anywhere between like 0.5 and 2. And the next part of that will explain why that is. So the 5, this one is a little bit murky. It's understandable, but it also depends on what your 3 was, right? Or what your first section was. So the 5% is you shouldn't have an outstanding balance of more than 5% risk at any given time. So meaning that all the trades you have on the board, at all times, they should be under 5%. Now, I want you to do the math on this real quick. If you are someone that is risking the 3% because you're aggressive and your maximum risk is 5%, how many trades can you have on at once? 1, right? Because if you have 2 trades on that have a 3% risk, you are at 6% risk, which is above that 5% rule. So if you're someone that is risque, right, you're going to run into trouble with that 5% number. But on the flip side, if you are someone that risks 1% per trade, well, now you can have 5 trades on at the same time and still be within that realm. So 5% is a little bit low for me. And again, everything we look at here is going to be based on your comfort level and your, how much risk you're willing to take on. I am willing to have more than 5% risk on at the same time. So it is what it is. That's something that you have to answer. But the underlying idea and principle is that you should manage how much your overall exposure is to the market, and you should have a rule that says I cannot risk more than this amount. Now, the 7-to-1, this is the one that I disagree with, and we'll talk about that later. I'll share with you some pros and cons, but just my philosophy on the market, just my philosophy on trading. And keep in mind, I'm a trader and not an investor when it comes, well, I am an investor, but I'm mainly a trader, an active trader versus an investor. It doesn't make sense based on how I view the markets, but the underlying principles of it do make sense. And we'll talk about that when we get to some more of the benefits. So the first benefit is this, and we'll start off with the 7-to-1, right, since we ended there. With the 7-to-1 risk reward, that means that when you win a trade, it should be 7 more times than what you lose when you lose a trade. The benefit of that, the main benefit of that, is really nothing to do with the actual trade, right? It's great to have a 7-to-1, don't get me wrong, but really mentally and psychologically, it's massive. Knowing that you need a risk reward of 7-to-1, what that does is that it really allows you to focus on the best trading opportunities. And understand, if you guys are new to trading, there's 3 types of trades, right? There are bad, horrible trades, things that you shouldn't be doing. That's when you're closing your eyes, you're just throwing money at the screen and hoping it hits somewhere. There are trading opportunities, right? There are things that you can trade. They're not the best trade, but it's like, meh, right? And then there are high quality, good trading opportunities. Now, I can tell you this. You want to avoid throwing darts. That's a bad idea. You probably want to avoid meh trades, right? You're looking for high quality trades. You want to focus on those really, really, really good trading opportunities. And what this 7-to-1 risk reward does is it allows you to do that, right? Because obviously, if you have a trade setup that has a 7-to-1 risk reward, I mean, you can make 7 times the amount that you risk, it's probably a good trading opportunity. If that's a hardcore rule, you're focused on only finding those trading opportunities. That helps you avoid the meh trading opportunities. And even though those meh trading opportunities are not necessarily bad ones, those are the ones that tend to get traders into trouble, right? We're entering the summer right now, and this is typically when the markets get really, really slow. And specifically, as I'm recording this, we're dealing with a lot. We have a Bank of Canada interest rate decision tomorrow. We have an ECB interest rate decision the day after that. We have non-farm payrolls on Friday. We've got tariff stuff happening all over the place, right? The market is in this state where it gets very, very, very quiet, and then it gets very, very loud for periods of time before going back to its quietness. And you combine that with the natural summer slowdown, and it makes for some really, really boring markets. Now, boring markets aren't bad, or summer markets aren't bad, but what it means is that the frequency of good trade doesn't show up as much. So during a normal trading time, whatever you want to call that, let's say you may get 5 good trading opportunities a week. Well, in the summer, you may get 1 or 2. So while you're waiting for these 1 or 2 trading opportunities, right, you're looking around the markets, you're scanning, you're doing the analysis. And well, traders want to trade, especially newer traders, right? So they start getting bored and they start seeing stuff. And you're like, oh, look at that. That could be a trading opportunity. And it is a trading opportunity. It's just a meh trading opportunity. But because they're bored, because they want the action, because they feel involved, or they want to feel involved, all their friends on social are in all these trades making all this money. They don't want to be left out, FOMO, right? They enter these trades. And these trades aren't necessarily bad, but they don't have the same quality of risk reward that they're supposed to be taking. So they may win some, they may lose some, but at the end of the day, at best, they're probably going to end up break even. They're more likely going to lose some money, right? For you guys that have ever been in a live trading room with me, you see this all the time where we'll do analysis and I'll look at it and be like, yeah, it's an opportunity, just like not enough meat on the bone. And what I mean by that is like, yeah, the market's at a good place. I got a good signal, but there's just not enough potential profit to make it worth my time. And I skip over them. And it's funny because you see newer traders and they don't understand, like, Akil, how come you're not involved? It's a good trade. And I'm like, well, I can only make this much, but I'm gonna have to risk this much to make that much. And unless I'm hitting that 90%, not worth it. So it's better off keeping your powder dry. So focusing on this 7-to-1 allows you to ignore these trading opportunities and really focus on the good ones. And ultimately, if you consistently take good trades, you're going to be a good trader. Another benefit of this 357 rule, right, is risk management. This one's pretty obvious. I told you this at the beginning, right? 3% is probably the max that you should ever risk on an individual trade. Again, lower than that is preferred, especially if you're a newer trader. I don't necessarily agree with the 5%, but I like the idea of, hey, keeping an eye on what your total exposure is. The truth is, right, good traders are great risk managers. And the truth is that many new traders don't care about risk management. Their goal was like, find trade, find trade, find trade, find trade, find win, 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 win. When the idea should be manage risk, manage risk, manage risk. It's really interesting because when I first got into this industry, I was thinking the same thing. Right? I was just like you, right? I need a winner, need a winner, need a winner, need a winner. And I'm talking to all these professional traders. I had the luxury of being surrounded by many pros of many different levels. I had retail traders, I had institutional traders, I had money managers, I had coaches, right? I got to be around these circles, and everyone in this circle was saying the same thing except for me. I was like, find a winner, find a winner, find a winner, find a winner. Everyone else was like, hey, got to manage risk, conservation of capital, don't go broke. And I'm like, what are you guys talking about? Until I blew a lot of money and I was like, oh, that's what you're talking about, right? It made perfect sense. So having this rule set forces you to focus on risk. It forces you to say, I can't throw all that on this one trade because I'll be over my risk limit, or I need to have a smaller risk per trade because I often get 5 trading opportunities at the same time. And if I'm risking 3%, I'm not going to be able to do that. So maybe I should risk 1% and allow myself to have more frequency while still keeping my risk small. And that is so important. So a massive benefit, and the biggest benefit of this rule, is the concentration on your risk management for an individual trade and overall. Now, psychologically, this rule plays a massive role as well. We often don't think about the psychological side. There we go. Words, right? The streak continues. Ding. I need one of those banners. You see them like the Simpsons stuff. This many days without accidents. This many days of speaking correctly. I am back to 0 on that. Hooray, right? I should just edit it out and you guys would never know. But psychologically, right, having that, going back to that 7 rule, right, the 7-to-1 rule, that plays a massive role as well, right? So one of the biggest things that kills traders is trading psychology. One of the biggest things that triggers trading psychology is, or your trading psychology meltdowns, is losing money. What do we call losing money? It's called a drawdown. Now, the deep, dark, dirty secret of trading is that every trader goes through drawdowns. Your worst trader out there goes through drawdowns. Your best trader out there goes through drawdowns. We all go through drawdowns. The biggest difference is professional traders know how to manage that drawdown. We have the confidence to continue trading through that drawdown, while newer and struggling traders go psycho and blow it all up trying to make a comeback, right? So here's how that 7-to-1 rule can help you psychologically manage and persist through a drawdown, right? If you know that your predetermined risk is 7-to-1, you know that you're going to make 7 times what you would lose on one losing trade. Therefore, if you take 5 losing trades in a row, which isn't fun, in the back of your mind, you still know that, hey, if I get 1 win, I'm going to make up for all 5 of those losing trades. Now, many of you guys are thinking, well, Akil, it should be 7 losing trades in a row. But if you remember that maximum drawdown recovery sheet that I spoke about, and I'm hopefully putting on the screen right now for you, keep in mind that every time, if you're trading a fixed fractional position size, meaning that you're trading a certain percent of your account per trade, each time you lose a trade, your account size gets smaller. Therefore, that blank percent of your account that you're risking gets smaller as well. So your position size shrinks as your account size gets smaller, right? So I don't have the chart in front of me, but it's probably closer to 1 winner making up for 5 losers to put you back in profit versus 7 winners making up, or 1 winner making up for 7 losers, which would probably still have you in the negative. But regardless of that, this gives you confidence because you know that you can lose a lot and still be profitable, right? So many traders out there are tricked, we're brainwashed into thinking like, I have to win, I have to win, I have to win. All this junk on the internet tells you gotta win 90% of the time, 80% of the time, 70% of the time. The truth is you don't. Look at the sheet in front of you right now, right? This is the sheet, I forgot what it's called, but it shows like the matrix of win percentage versus average risk reward. I'm doing this without it on it, so I'm just guessing right here, but Go look at the two axes and line up risk reward, line up average win, and you can see what exactly you need to do to be a break-even trader or to be in profit, right? The shaded in part, which is probably green or blue, depending on which one I pick, will be the area that puts you in profit. You don't have to be a 90% trader, right? That's what this is telling you. Math is telling you this, and math don't lie. So I'm not even gonna try to do weird math in front of you because my brain is dead from watching kids all day. But if you look at the sheet, if you are a 2-to-1 trader, all you need to do is win 33% of the time to break even. A little bit more than that, spreads, commissions, all that stuff, but just stupefy it, right? 33%. We're talking about being a 7-to-1 trader, which again, I can't do math right now, but you would have to win a lot less than 33% of the time. Think about the confidence you would have as a trader knowing that you can come in and lose a lot below 33% and still be profitable. Now, I'm not saying it's easy, right? Because the mental side of losing is very, very tough. We spoke about that in the DKC podcast I shared a few the other day, where one of the reasons I scrapped that strategy is because the win percentage was only 33%, and I didn't think it would be good for newer traders to manage that. But the risk reward also wasn't 7-to-1 on average. And if you're someone that is confident with that 7-to-1 risk reward, if you know you're always getting it on every single trade, then you can walk into the building and lose and just like brush losses off you like you're Superman, right? You're walking into Superman, the little bullets they're firing at you are losses, you're just picking them and throwing them out. Oh, Lord, this doesn't bother me, because one win's gonna make up for it. And that's very empowering, especially because we give so much power to losses. You know, newer traders tend to think that a loss is the end of the world, and we start thinking, I'm not good, I'll never make it, I'm gonna lose all my money. To have that confidence to understand that you can lose and to keep doing your same thing is what professional trading is about. Again, going back to a live room example, many of the traders I work with, they see me at my best, they see me at my worst, right? And plenty of times I am on losing streaks where I'm like, hey guys, just lost another one, that's 4 in a row today. And they're like, Akil, how come you're not freaking out? I'm like, because I don't care. I don't care. I know my numbers. I know my math. I know that I can absorb these small little losses and flick them off as they hit me because my wins will make up for it. I don't have an average of 7-to-1 risk reward, but I'd feel even more confident if I had that. So psychologically, it helps massively with being able to, I don't want to say suffer, I was going to say suffer through a drawdown, but I guess suffer less through a drawdown than the trader that needs to win 80% of the time. If you're someone that has a very low risk reward and you need to win 80% of the time to be profitable, and you take 5 losses in a row, you're probably sweating out there. Now, let's talk a little bit about the downside of this rule. Again, the 3% rule, I think, is a good rule. I think 3 is the max risk that you should have. But if a trader is too literal, right, they may risk 3% thinking that it's okay, even though they probably shouldn't be risking 3%, right? Many traders take whatever people say literally. And again, just because 3% is the max, it doesn't mean that you have to risk the max. It just means that's the ceiling of where you can go. But if you are a newer trader and you're saying, okay, well, 3%, I have to risk 3%. I can't risk anything under it because the rule says 3, 5, 7. You're going to go ahead and risk 3%, which is probably a little bit too much to begin with. And you're just going to, you have the potential of building yourself into a bigger drawdown than you would if you risked 1%. Again, think about it like this, right? If you risk 1%, you can lose 3 times more than you would with 3% and still survive. And trading is all a game about survival, at least in your first year. The 5 rule is also a little bit weird as well. I told you, I thought that rule was a little bit low. Here's where it may hurt traders. If a trader is saying, hey, my max risk per portfolio at any given time needs to be 5%, and if I'm risking 3% on a given trade, I can only be in 1 trade at a time. If I'm risking 2% on a given trade, I can only be in 2 trades at a time, and this could lead to some other complications. One is adjusting their risk on another trade to make it fit the rule, right? So if you have a 5% total risk rule, and let's say you get triggered 3 trades at the same time. Well, your first trade is 2% risk, right? Your second trade is 2% risk. Now you're up to 4. You only have 1% risk left. So on that final trade, if you get another valid signal, instead of risking your normal 2, now you're risking 1, which is less, all because you have to fit into this rule. Now, some of you are saying, what's the problem with that? Well, I'm a big fan of consistency because I believe in long-term numbers, meaning that individual numbers don't mean too much, but the consistency in those individual numbers in the big picture, that's what means a lot. And we can throw out all different types of scenarios, but think about this scenario right here. So what if your first 2 trades lost, right? You took a 2% hit, you took a 2% hit, right? Boom, boom, right? But that third trade you took where you're risking 1, that one was a winner. Well, you got your 7-1 or whatever it was, but remember that 7-1 is a little bit less because that 7-1 is based off a 1% risk instead of a 2% risk. So you really only brought in half the profit that you should have, which means that you're not necessarily making up for those other 2 losses the same way you would have if you had a consistent risk. If that didn't make sense, just rewind this and listen to it again. Another option following up on that will just be skipping trades, right? We'll have a trader that has, 3 signals. Again, they take their first 2 at 2%. And then the last one, they're like, well, Akil said, don't reduce your risk to make it work. So I'm just not going to take the trade, right? I see a lot of traders, or I talk to a lot of traders who have this rule where it's like, they can only be in a certain amount of trades at once. And in theory, that makes sense. The idea is that they're protecting themselves, but they're also limiting themselves. Again, if you look at the law of large numbers, right? We don't know on an individual basis which trade is going to win. We don't know which trade is going to lose. If we did, we'd all be very, very wealthy and never lose a trade because we would take all the winners and avoid all the losers, right? Boom. But unfortunately, the reality of the market doesn't look like that, right? We don't know our daily win percentage. We only know what our win percentage and our return on investment would be, or will be, most likely, after the year, right? After a large sample size. I say that because the problem with skipping a trade is, yes, the intention is right. I am not taking a valid signal because I don't want it to put me over my overall risk profile. But again, what if that valid signal is your big winner? Again, what if the first 2 trades you took lost, but the third one that was on the table, that would have been the one that won and made up for the other 2 losses, but you never took it, and now you're in an awkward situation, right? So here's how I handle it in my personal trading. I set up my trading portfolio in a way, and this is never going to happen, but it's risk management, I guess, where theoretically I could have a position in every single thing I trade at the same time and actually be in the trade. Again, that will never happen. It has never happened. I'm never even in more than half of them at the same time, maybe a little bit more than half. I've been in like 5 trades at the same time, especially as a day trader, but as a swing trader, not even more than half. But the point is I could. And I put that safety protocol in there because I don't want to miss any signal, right? My job is to take the signal, right? The short-term signal doesn't mean a win, doesn't mean a loss, but I want to take all good trades that show themselves to me because that's how I can replicate my back testing as best as possible in real life. So I want to be able to take the valid signal. Win or loss, I don't really care. I know if I take all valid signals, I will be this much profitable at the end of the year. So I set my risk management profile up in a way that I can take every single valid signal and I don't have to kind of back off and skip this and skip that. I actually had many years ago, I traded a few pairs. It was Euro, Aussie, and Pound Aussie, for example, and I had to dump them from my portfolio. The reason was these pairs had massive ATR, so there's a lot of movement on these pairs. And for many of these pairs, it required to trade them, it required a stop loss that was bigger than my allowable risk. So pretty much I was taking every other trade. What that means is this: there would be a trade that fit my risk profile and I would take it, but then the next trade would be too big and I couldn't take it. Then the next one I would take, the next one I wouldn't take, right? And before I knew it, I was pretty much just randomly taking trades instead of executing my edge. Speaking of random, if you heard the last podcast and you know the issue with randomness, you don't want to pick and choose which one's going to be a winner or a loser. You want to take every single one because that's the only way the odds are going to play out in your favor. You can take it back to the coin flip game where it's like, hey, if we're playing heads or tails and you're betting on heads and I'm winning on tails, you don't want to pick and choose like, okay, this time I'm going to bet. Nope. This time I'm going to bet. No, like you want to consistently bet every single time, especially if the edge is in your favor, because that gives you the best opportunity to return the numbers that you expect to return. Now, the problem I have with the 7-to-1 risk reward is this. We're going to head to the charts in a little bit, but let's set it up before explaining it. And understand that this is just my philosophy on trading, or my philosophy isn't the king philosophy. Every trader is different. We had a good conversation in the live room this morning about the difference between how counter trend traders think and how trend continuation traders think, and how you can literally show both traders the same chart. And based on their general philosophy and their approach, they will see two different things. An example we had this morning, traders were looking for, oh yeah, we're going to look for an extension. This is a pullback. I'm going to buy. And all the counter trend traders are like, no, we never broke structure, so I'm going to stay out of it. And they're like, how can you stay out of it? And we're just both seeing different things. So this is my philosophy. I am a technical trader. I use technical analysis to trade the markets. And I should premise this with saying that I understand the rule more from an investing standpoint than a trading standpoint, but as far as this podcast goes, because it's called the Trading Coach Podcast, we're going to focus on trading, right? My show, I do what I want. So I'm a technical analyst, right? I use the charts, the price charts, to find my trading opportunities, to do my analysis, to find my entries, to find my exits. For me, all of my exits are based on price action. So there are specific levels on the price chart where I say, hey, if price is going to go higher, then I think we're likely to go higher to this level. And I pick that level not just because I closed my eyes and threw a dart at it, because it's a technical, relevant, and valid level. So the problem I have with the 7-to-1 risk and having that as a hardcore rule is that it causes you to place stops or targets based on reasons that aren't really technical, but reasons that are simply based on risk reward. Let me load up a chart and see if I can give you an example of this. So I'm currently looking at a chart of the euro dollar. And again, I'll do my best to explain this to the non-visual audience out there. The euro dollar, and this is actually something we looked at in the live trading room this morning. So this is a trade that's on my radar. But the euro dollar has just put in an exhaustion pattern, a loss of momentum pattern. If you're familiar with rising wedges and rising channels, we just have one of those. So it's to visualize it, it's an opportunity where the market put in a clear directional move. We kind of started losing steam, and instead of like a straight move up, the market started consolidating, but still kind of pushing up, and then it fell off a cliff from there. So I always like to explain deceleration patterns as like imagine throwing a ball in the air, where you throw it in the air and immediately it leaves your hand and has a lot of force going up, but eventually it gets to its apex and it kind of bends off before falling back down. That's what these patterns look like. So we had this rising channel, and then we had price action fall out of that rising channel back down into a previous level of structure. And this is going to be a pullback trade. So imagine that price has given you a retracement. We're looking to buy it. Now, let's take a look at someone who is setting up that 7-to-1 risk reward, but first basing it off their stop loss. So they're deciding to put their stop loss below structure because that's where they want to have it, which is a smart move. Now, what they're doing is they're setting up their reward, their target, so that it is 7 times that. So we're going up. Got to scroll up my screen. See, it's so big, I don't even have room on my screen. Up, until we get to 7, which is right here. So beautiful risk reward. 7-to-1 looks amazing. You would kill to have this every single time. However, the question that you want to ask is, why is my target there, and is my target in an area that will actually get hit? Now, I am a simple man. I trade by very simple rules. And I would say this, I don't often take targets, but when I do, I make sure my targets are at a place where I think price is going to go. Trade thirsty, my friends. Right? Dasaki, that was the Dasaki's commercial, right? The most interesting man in the world. Long time ago. Anyway, the point is, my simple man, simple rule, my target taking philosophy is this. I want to place profit targets at a level that I think price is actually going to go to. Boom, right? It makes perfect sense. If I don't think price is going to go somewhere, why the hell would I have a profit target there? Right? Why would I bet on a team that I don't think is going to win the game? Right? Doesn't make any sense. So the problem is when you're creating this 7-to-1 risk reward, simply because we need that magic 7-to-1, right? I don't know why I held up 2 fingers. It was supposed to be a 5 that went with it, but 7-to-1 risk reward, we're putting our profit in an area that we may not think price will hit, right? If I zoom out on this chart, I'm on the hourly, I'm gonna go to the daily to kind of look left for levels of structure. I'm gonna find my risk reward. Did I delete it? Where did it go? Oh, okay, here it goes. Let's. I'm gonna widen it out some so I actually see it on a daily. I'm gonna see that risk reward. I'm gonna move my line up, and I'm gonna ask myself, are we at a level that I think price is going to go to? Well, I'm looking left. We are at a minor level of structure from some time ago, back in 2022. But the level that I would be more comfortable taking targets at is a previous structure high. So again, the first level that I had targets at based on the 7-to-1 risk reward is at the price point of 116.60s. The level that is more important is about 115.70, so about 100 pips below that. So am I comfortable taking this trade knowing that I don't think price is actually going to go to this higher level, but in order to fulfill this magic thing, I have to put it at that level? No, right? So that's a problem right there. We can also have it as the opposite. So let's say a trader's like, you know what, Akil? I'm going to place my targets based on where I think price is going to go to. Let's say the high right here. I would actually do the close at about 115.11, but let's just keep it consistent by doing the high. So what they do is they set their target first, and then they say, well, I got to have this 7-to-1. Right now, if I kept my stop loss the same as the previous trade, then I'm looking at pretty much almost a 5-to-1 risk reward. But my rules say 5-to-1 isn't good enough. I gotta have that 7-to-1. So let me shrink this stop loss up to my 7-to-1 right around here, right? So now you have your 7-to-1. You're saying, Akil, problem solved, baby. I put my targets where I think price is going to go. I'm a simple man or a simple gal just like you. And I would say, yeah, but now in order to meet this magic qualifying 7-to-1 thing, you had to reduce your stop loss. So yes, I am happy for you. Applause for putting your target level at a place that you think price will actually go to. Good job for you doing that. But now your stop is in a different place. A simple man like me has a simple rule for stop losses. That simple rule is I don't often play stop loss. No, I always play stop losses. I don't even want to put that on record. I always play stop losses, and when I do, I place my stop loss at the place that price should not go to if I am right. So in the original scenario here, we had a stop loss below a key level of structure, and we said, hey, if I'm right, price action shouldn't go below this key level of structure. Now we had to reduce our stop loss in order to get the 7-to-1 risk reward, and now it's tighter to our entry, and it's not necessarily in a place that is safe, meaning that price can go to this level. As far as the structural integrity of the trade goes, it could still be 100% right as far as our directional projection, but I may be taken out of the trade simply because I put a stop loss there. And the only reason I put a stop loss there is because I had to hit this magic 7-to-1, right? See, this is my philosophy on target taking. So this is why I say I agree and I disagree with the idea. I like the idea as far as the premise of allowing you to concentrate on consistently putting yourself in a situation where your winners are going to outweigh your losers. But I also do think there should be some fluidity in there, meaning that we should have the ability to, base those decisions on what we're seeing on the price chart and the uniqueness of the trade, because every trading scenario is different. You're going to have trading and investing situations where you can get a 10-to-1 and it's a natural 10-to-1. You don't have to force anything. But there are going to be others where you have to get a 5-to-1 or you can only get a 5-to-1 based on doing things the right way. And do you necessarily want to throw away those trading opportunities? Like a 5-to-1 is a great risk reward, and it could be not a once in a lifetime, but a once in a month, a once in a year type of opportunity that you're now passing up. So like anything in trading, I think it needs to be fluid, like my dance moves here. I'm doing a little wavy thing with my arms for you guys watching because I'm grown tired of this very long podcast. But I do like the 3-5-7 rule as an overall premise. Now, before we go, let me know what you think, right? Shoot me a comment. I know there's a comment section on Spotify. You can DM me on socials or under the YouTube video as well. One, do you like the 3-5-7 rule? Like a hardcore rule, I will use it every single time. Two, do you kind of like the idea of it, but you'd like to kind of make it fluid and make some changes to it depending on the trading situation? Or four, do you completely hate it and you have a different rule that you use, right? If you do, share that with us, share that with the Trading Coach podcast community, and you never know, it may turn into a follow-up podcast episode. Speaking of follow-ups, this podcast a little bit followed up on the last podcast I did about trading and randomness. If you haven't listened to that already, make sure you do that. Episode 1169 is Trading Random. It's a great episode where I get a little bit heated, and I apologize for that, but I don't really apologize because it was deserved. I would also recommend checking out episode 1130. It's titled Let's Redefine Normal in Trading. If you're someone that's new and you're kind of wondering, like, what should I expect from my trading? Should I expect 7-to-1 risk reward? Should I expect this type of return on investment per year? This is a great episode talking about how you can redefine what's normal for you in your specific situation. So give those episodes a listen, give this podcast a follow, and until next time, plan your trade, trade your plan. Akil out. But back in to turn off the camera.